Good day, everyone, and thank you for joining us today. This is Jason Leesui, and I'm joined by our portfolio manager, Kyle Wilson. Our agenda for today is threefold. First, briefly discuss our True Tactical campaign and how to communicate this concept to investors, followed by a fund update and market update from Kyle. If there are any questions, please feel free to type them into the question box, and we'll address them at the end of the presentation. Uh, Last week, we introduced our True Tactical concept to the advisor community. Many advisors asked us how they can explain this concept to their clients, especially those who have limited investment knowledge or experience. And we believe True Tactical is an investment strategy that will change the way investors build investment portfolios going forward. So the following is a brief introduction of the basic principles of True Tactical explained for investors. We'll hope you find this useful for your clients. If you're a hockey fan, it's very likely that you've heard of Bobby Orr. He played in the NHL for 12 seasons, 10 of them for the Boston Bruins during the 1960s and 70s. During his time in the league, he revolutionized the way the game was played and really altered our thinking of the role of a defenseman. He was a defenseman who scored goals, rushed the puck up the ice, set up teammates, and sacrificed his body to block shots and defend his goalie. As Sports Illustrated E.M. Swift commented, and I quote, "A defenseman, as interpreted by Orr, became both a defender and an aggressor, both a protector and a producer. Orr was more than an opportunist, he created opportunities," end quote. He won 18 individual awards in 12 seasons with 2 Stanley Cups. What was probably most impressive about his awards were the type of awards he received. Not only was he voted as the top defenseman in the league 8 times, but he also won the Art Ross Trophy as the top scorer in the league twice, the only defenseman to ever win it. He also holds the record for most points and assists in a single season by a defenseman. And not only was Orr the first defenseman to record 100 assists in a single season, he was also the first player to ever do so. And the list could go on and on. The point is that Bobby Orr revolutionized the game because he broke with all conventional wisdom about playing defense. He realized that in order to help his team compete, he needed to become a skilled two-way player. On the next slide, this is a useful strategy, a useful analogy to describe the essence of our True Tactical approach to investing. Breaking with conventional wisdom about how equity mandates should invest, we sought to redefine the parameters of a traditional equity mandate in order to enhance an investor's ability to compete in the markets. An equity mandate that was designed as a two-way strategy, able to play both offense and defense. The key to this mandate is its tactical range, with a flexible equity allocation between 0 and 100%. This flexible range is crucial in order for our mandates to participate fully on both on offense when the markets are bullish and on defense when the markets are bearish. Many traditional tactical strategies have a limited range, falling between plus or minus 10% to plus or minus 50%. They will move within their predefined parameters, but not much more. On the next slide, this graphic will help to explain our process, or sticking with the hockey analogy, our game plan. The horizontal spectrum line at the top is our hockey rink. We move within this rink based on the flow of the game. If the equity markets are bullish and we want to shift into offensive mode, i.e. towards the left side of the spectrum, our mandates will likely have 100% allocation to equities. If the equity markets are bearish and we want to shift into defensive mode, i.e. towards the right side of the spectrum, our mandates will likely have 100% allocation to fixed income. The process that determines which side of the rink we're positioned on throughout the game is based on our relative strength ranking reports below. These ranking reports are produced through millions of calculations each night across thousands of investments to objectively analyze where money is flowing within the markets. When the equity markets are bullish, we will tend to see equity investments ranking higher in our reports. Conversely, when equity markets are bearish, we'll tend to see equity investments rank lower, and defensive investments like bonds, cash, and precious metals will rank higher. This is a rules-based, objective, and unemotional process that helps us to determine where the puck is moving so our mandates can continually shift between playing offense or defense. For more information on our True Tactical process, you can visit us at siawealth.com, and there's more information there for you. Also, just wanted to mention that if you're looking for CE credits, you can go to our website and register for the replay of our True Tactical webinar for advisors and receive 1.5 CE credits. Or you can simply reach out to us and we'll send you the registration link. And now I'll turn it over to Kyle for his fund and market update.
Thanks, Jason. And yeah, I am Kyle Wilson here, one of the portfolio managers at SIA Wealth. I just want to give you guys a little bit of a January fund update, kind of following up on our last webinar. We went over kind of 2020 in review. So moving forward, as we continue to do these, we'll try and keep you guys up to date with what's happening in the funds and what we are kind of seeing in the markets. January, was pretty positive for the markets altogether. One interesting thing that we noticed was a previously lagging area of the market in small caps did a pretty big catch up relative to the big cap names. We did find that our equity portfolios did really well relative to the benchmark. We're definitely excited about that, and I'll touch on a little bit more of that in a few moments. And an interesting kind of trend change or trend follow that we had witnessed here in the last few months that has benefited the portfolio is kind of a shift towards adding some healthcare and some utilities names, particularly cannabis and clean energy. Both of these areas are kind of seen as potentially benefiting from the change in the US political leadership. And following that in November of last year, we've kind of seen them creep up the rankings, and we have added to our positions in both of those areas, at least in January, and if not in December and November as well. So first, just want to highlight the BMO SIA Focused Canadian Equity Fund. This is just a year-to-date chart. It was a pretty hot rally there at the beginning of January, and a little bit of that was given up in the last week of the month. Now February again has kind of broke out to new all-time highs, but this is the January call. So you can kind of see here, we ended up about 4%, almost 4% up for the month of January, whereas the TSX Composite Index was just slightly negative. So year to date, that puts us in a pretty good spot, and following up on our strong, 9 months that we've had since entering back into the green zone, this fund has actually seen some pretty significant gains, and we really like its positioning going forward. On the next slide here, I'm just taking a look at what kind of the holdings and the holding breakdown is. So you can really see that we are weighted higher into utilities, industrials, materials, and healthcare, kind of round out 3/4 of the portfolio allocation. But we do have exposure to 8 different sectors at the GICS level 1. Some clean energy names like INE was added in January. Ballard Power and Boralex were picked up in December of 2020, and we've held Brookfield Renewables since last May. As I said, we've kind of been adding to that position over time. It's definitely a spot that we like to be in right now, and we'll, continue to monitor that as that plays out here over the next few weeks. Another really interesting thing that we like to stand behind with this fund is that it has a high active share value of about 96%. This is really just a result of being a relatively concentrated portfolio with only 15 holdings, but just a really unique non-index exposure to get some Canadian equity in your portfolios. And while we are excited about this right now, we really just wanted to kind of tell you what makes the BMO SIA Focused Canadian Equity Fund so unique. It is a high active share and a concentrated Canadian equity strategy. As Jason mentioned, we have the true tactical approach that the equity allocation can range from 0% all the way up to 100%. More often than not, it's going to be 100%, but we do have the ability to take a defensive positioning and try and get out of the equity markets when the time arises. And we do take a quantitative approach, which could definitely add some style diversification to portfolios that are more focused on fundamental and or technical analysis. And one reason why you can definitely consider this fund for your clients is that we are a high active share value. In 2020, we averaged above 90% active share, so we were very different from the benchmark. And for the year, delivered pretty close to benchmark returns. But if you remember last year in the volatile period of March, we actually kind of sidestepped a little bit and minimized some of that volatility and risk. And that's what made us look very different from the benchmark last year. There's a couple ways that we think that you can definitely apply this into your clients' portfolios. A really simple way is a 15% allocation will actually shift from a traditional, say, balanced portfolio of 60% equity and 40% fixed income to a more defensive, say, 45% equity and 55% fixed income when bear market risk is anticipated. This is exactly what happened last March. So if you do feel that the markets are still pressed for continuing to hit new highs, or you feel that there might be some downside in the near term or in sometime in the future, this is a perfect place for a fund like this. It also works really well as a sector rotation within your Canadian equity sleeve. You could see on the last slide I showed that we are pretty concentrated into just a few sectors, and it'll allow you to kind of overweight some of those strongest areas of the market without really having to lift a finger. And again, if you have any questions on this or how to implement this as a true tactical approach, Jason said, feel free to reach out to him. On the next slide here, I just want to take a look at the BMO Tactical Global Equity ETF Fund. In a similar fashion, we have seen some of the same changes on a sector basis that we saw as the Canadian Equity Fund. So a little bit of an increase in January to the healthcare space, as well as we have picked up some of that clean energy trend as well. You can see year to date, we kind of a similar fashion. We were able to put out a positive return in January relative to our benchmark, which sets us off to a nice start to 2021. And our 9-month number there, 26%. That's kind of since we got back into the green zone. We have been doing really well, and we really like some of the holdings within the fund here. And here's the breakdown right now. You can see that we are primarily weighted to US equities, about 63.7% of the portfolio. However, 4 of those positions are Canadian dollar hedged. And those have definitely helped us over the last 6 months or so with the rising Canadian dollar relative to USD. We are still seeing some of those pockets within the US equity space, like technology, like healthcare, and consumer discretionary, which is about 2/3 of the portfolio. And we did add in January Canopy Growth and Lightspeed. And actually, this one was the first to kind of jump onto the clean energy trend. We did add the iShares Global Clean Energy ETF back in November of 2020, almost right after the election there. And now here we're just going to take a look at, these are our funds that we sub-advise for BMO. I really just kind of wanted to highlight that that 9-month number is about the same time we went back into the green zone and started participating in the equity markets. We do feel that most of our portfolios have been pretty strong over this time period, if not in line with the benchmarks, give or take a few percent. And we're definitely looking forward to what these funds can do here in 2021. And now we're just going to jump into a bit of a market update. So I'll go over a couple charts here, just some things that we're looking at and seeing. And this is a little bit more, I guess the last few slides we were talking about up until the end of January. So this is going to take a little bit of a perspective of what has happened over the last few weeks, just to give you some more timely information. Definitely going to look at the S&P 500 index. Big triple top breakout pattern hit, just at the end of 2020. We're continuing on that trend as the benchmarks continue to hit some all-time highs last week. Coming up at that 4,000 level, we might see some resistance for the S&P 500, but there's definitely some strong support as well around that 3,500 level. It'll be interesting to see what happens over the next few weeks. Next, we'll talk about the TSX Composite Index. Really big here in February, actually broke out to new all-time highs above 18,100. Really struggled to kind of get through that level towards the end of last year. The next significance resistance level probably comes in at around 20,000, perhaps 19 as well, if we're talking about psychological levels. And support, definitely, we can see some at the 18,000 level, which is a little bit tougher to get through, and a little bit lower down at 17,000 as well. One of the reasons why the TSX has done well and why Canadian equity has seen some strength recently is definitely on the back of this move in crude oil, which has happened this year. And I guess it started in the middle of last year. Crude oil continues to climb now. It broke out the long-term downtrend just in November of last year. A big thing to this move is that the OPEC Plus is, planning on restraining output until mid 2021 this year, and then obviously we'll see what happens after that. Definitely going to run into some potential resistance in the near term, possibly at $60 and $64. We could see some support between $51 and $55. So we could definitely enter a period of range-bound price for the price of oil. Not surprising, as we did kind of see a similar period between 2019 and 2020, kind of hovered around this level before breaking down to the downside there for all of 2020. Another highlight here is the USD CAD. We did see a steady decline through several support levels since last March. So there's a pretty predominant column of O's here as it's slowly been creeping down. We're definitely nearing in on some support at the 125 level, which was held in May of 2016, about the same. The last time we saw this big decline in USD relative to the Canadian dollars. We'll see if that period or that point holds up, and if not, 122 has also been a support level in recent years for the USD CAD. Upon a reversal, the resistance levels kind of set around 130, and we have seen the USD CAD kind of range bound between these levels, 126 to 130 over the last couple of months, and that might continue to hold through to the over the next few months here. Just a sector I wanted to highlight was the SI charts, electronics and semiconductors, EWI. So this is just an EWI that tracks 50 very liquid electronics and semiconductors in both Canada and the US. And we did see a pretty big breakout here, and we set new highs just after a pullback which happened in January in the last week. It was enough to get a 3-box reversal there, but that support held up. Reverse trend, and this sector is now showing some strength again. We do have some exposure to this in various places within our BMO mutual funds, either through ETF and or stock exposure. And we'll see what continues to happen. It has been a very strong space within the market over the last several years. A new one that we really haven't seen this kind of strength until the end of last year is the SI charts automotive EWI. We did see a significant breakout back in November, and it took out the highs set back in 2018. It doesn't really see where the resistance is to be set, so there could be some continued move upwards, but a pullback might be due as well, as this has been a pretty high pull up. 10 SMAX here indicates some high relative strength in the near term relative to the asset classes. And again, this is another sector that we do see some exposure to within our funds, either through some of the individual stocks that we hold or some of the ETFs that are in there as well. This also kind of goes to the consumer discretionary space that has been booming as well. So this is definitely a part of that segment in the market. And here's just our fund codes right here for those of you that either want to know what different series we have and some of the fees associated with it. And with that, I'll turn it back to Jason. Thank you very much for tuning into our January fund update and market update. And Jason, if you want to take it back here and wrap it up.
Thanks, Kyle. Yeah, again, just a reminder, if anybody has any questions, please type them into the question box. I had 2 here right off the bat here for you, Kyle. You showed a chart of the USD CAD where the US dollar was falling pretty much since last March. Can you explain some of the shifts that occurred in your funds as a result?
That's a really good question. Thanks, Jason. And we have actually seen a little bit of a shift, well, actually not even a little bit, a pretty large shift within the relative strength rankings for most of our universes that we're analyzing. So throughout the second half of last year, we did see an increase in Canadian equity in our ZFN fund, as well as in the BMO Tactical Global Equity Fund, as we sold out, what had historically been above 80% US equity. That has come back down to almost 50-50 or 60-40. It has varied over the last few months. But we definitely reduced that US equity exposure within that pool. We do have some currency hedged positions within the BMO Tactical Global Equity Fund, and those would have been in the portfolio for probably the last 6 or 7 months. That's another way that we've kind of seen this trend affect our rankings. And even in the BMO Tactical Global Bond Fund, we have shifted to an slightly increased weight in Canadian dollar or Canadian denominated fixed income, and reduced our weight to just below 50% on the US exposed fixed income. So kind of all of our portfolios have definitely had a bit of that shift over the last 9 months or so.
Great, thank you. And the next question is, your international equity equal weighted index is still ranking high on your SI chart system. Can you discuss how this is impacting your ETF selections in your funds?
For sure. So we do definitely have some international exposure in the BMO Tactical Global Equity Fund, which is our global fund. I'll just flip back here to take a look at that. So we're at about 18%, and that is exposures kind of pulled from the BMO MSCI Europe high quality ETF. That one is also Canadian dollar hedged. The iShares MSCI World has a large international component to it. We do have the BMO China Equity Index ETF as well. And the BMO Global Consumer Discretionary and the Global Clean Energy ETFs also have some names that are outside of Canada and the US. So we do definitely have some exposure, but we are still seeing some pockets of strength in, say, Canadian and US equities as well.
Great, thank you. Next question is, pot stocks seem to run real hard with the attention through the Reddit feed. Does this concern you for your purchases for your funds?
No, that is a great question, but for us, we still do have some exposure. There is a good fundamental, I guess we don't do fundamental analysis, but you can still understand that there is a good fundamental reason for strength in cannabis as a result of the US election. The Democrats, most people would agree, are more likely probably to advance the legalization on cannabis in the United States. That's certainly something that is probably being priced into the recent rally. And if that should, I guess, turn the other way, we are prepared to get out of those and move into other areas of the market.
Great. Any concern with stocks like GameStop and AMC with how those things moved, with maybe they didn't have the strong long-term fundamental story behind it? Any issues with those with regards to your portfolios?
Well, a couple of those have not really been in our area of analysis. They are quite high volatility even prior to, I guess you could say, them becoming a meme stock. For the most part, we try to do a little bit of due diligence every time that we look into adding a new position, but we are going to follow where the strength is, and that's kind of something that makes us very unique relative to other managers. But no, for those, I guess specifically, we didn't see them, they weren't in our universe at the time, and so we kind of didn't even really have an opportunity to take a look at them while they were skyrocketing up and then back down.
Great, thank you. That seems to be all the questions for now. Again, thanks everyone for joining us today. Again, if you're looking for CE credits, please visit us at our website, or just send us an email and we'll send you the registration link for that. Until then, we'll be back in mid-March for our next monthly webinar. Have a great week, everyone.